Welcome, everybody. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for registering for part 2 of DMG's Dialogs. It's a 6-part series webinars on market updates and investment strategies. Part 2 is, there's 2 topics actually: how the housing sector has been impacted by the economic slowdown and how entrepreneurs are leading their companies through an unexpected year. Our sponsor is DMG Investment. Founded in 2013 and headquartered in New York, DMG is a leading global real estate investment management and development firm focusing on housing, student housing, condominiums, multifamily, and modular construction. By combining the joint expertise of their talented people, they are able to offer clients a vertical integrated investment platform, resulting in outstanding reliability and the prospect of share growth. The DMG 6-part webinar series will take a deeper dive into how to navigate the current market and analyze the investment challenges and opportunities for 2021. DMG Investment will also guide participants on new innovations in construction and offer insight on investment strategies in the multifamily assets. In part 2 today, we'll discuss the following. What's the impact from COVID-19 to the housing sector in New York and New Jersey? How has your brokerage been reacting to the economic slowdown, or if there is a slowdown? What has your firm done to stand out from your peers and be unique? What can we still learn from the traditional brokerage style and adapt to the current market? How have buyers' focus shifted since the COVID-19 location, pricing, expectation, or general behaviors? Guys, Q&A will be at the end. So if you have a question, please type it up and stick it into the Q&A section, not the chat section. Today, our moderator is Kathy Hobbs. She is the owner and interior designer and she's also the Emmy Award-winning TV host. Welcome, Kathy. Tyron Byron, president and broker of CJ Dalton. Welcome, Tyron. Michael J. Romer, managing partner of Romer DeVos, and Michael's an attorney. Michael Cohen, vice president of Proceda Funding. Jules Borbelli, COO of Oxford Property Group. Tyron, why don't we start off with you, Tyron? Why don't you give us a little 1-minute short live bio about you and your company?
Hi, I'm Tyron Byron. I am the president and broker of CJ Dalton. I have the pleasure of also serving as the lead real estate consultant for DMG Investments and act as the sales director for their 204-unit condominium building, One Park in Cliffside Park, New Jersey, that is right atop the Palisades with sweeping views of New York City. And I have over 17 years of experience in the real estate industry in both sales, leasing, and property management. And my firm focuses on multifamily new developments, as well in sales and leasing, as well as luxury single-family homes.
Thank you, Taryn. Jules?
Hey. Hi, everyone. My name is Jules Borbelli. I'm the Chief Operating Officer and Principal Broker at Oxford Property Group. We're a New York, Manhattan-based real estate agency. We have approximately 800 agents, and we're primarily in New York, but we're also licensed in New Jersey, Florida, Connecticut, Pennsylvania, and we just opened an office in upstate New York recently. I think that's about it. Thank you.
Thank you, Jules. Michael Cohen.
Thanks for having me on, Anthony. I work at Proceda Funding and Advisors. It's the exclusive fund manager to the 100 Mile Fund. We run a boutique mid-cap size private equity fund based in Englewood Cliffs, New Jersey. We're predominantly a balance sheet private lender, where we focus on construction, bridge lending, mezz, pref equity throughout the Northeast. The target markets are New York, New Jersey, PA, Connecticut, with deal size ranging from $5 million and up. We've been predominantly focused on multifamily. We believe it to be a very good risk-averse asset class as we went through the pandemic. Our pipeline continues to be robust, which I think is a good indicator of what's happening. And once again, thanks for having me on and looking forward to talking to the panelists.
Thank you, Michael. Michael Romer?
Morning, I'm Michael Romer. I'm a real estate lawyer here in New York, just completed my 20th year of practice. I'm the managing partner of Romer DeBas, a 25 attorney law firm based in Midtown Manhattan. I'm also the co-founder of the New York Real Estate Center, which is an online real estate education platform in New York. So our office represents buyers, sellers, landlords, tenants, lending institutions in both residential and commercial real estate transactions. And I'm happy to be here today. Thanks.
We're happy to have you, Michael. Our moderator, Kathy Hobbs.
Hi everyone, I'm Kathy Hobbs. I own Kathy Hobbs Design Recipes, which is an interior design and home staging company, working primarily in New York City and upstate New York. But before that, I was a newscaster, mostly here in New York. I was a newscaster for 20 years. We're currently building a 12,000 square foot warehouse in the Hudson Valley as we expand. We specialize in real estate staging and styling, and I'm honored to be moderating today's panel.
Thank you, Kathy. So are we. Ladies and gentlemen, without further ado, Kathy Hobbs.
Let's get started, everyone. So we are more than a year into the pandemic, and we are seeing, of course, loosening of restrictions. But what are we looking at really current market? And as we spring forward to the fall, we've all heard rumors about kind of this big return to normalcy targeted for the fall. I'm going to start with Michael Romer first, because I know that you have a pulse on various aspects of the market. What would you say to this?
Well, you know what? It feels like forever ago when it was 2 weeks to flatten the curve. And now here we are, 14 months basically past then. And, I have to say, I'm here in Midtown Manhattan. I think to answer your question, it really depends upon where you are and whether it's residential, whether it's commercial. As far as the residential market in Manhattan in particular, we just completed our busiest first quarter of a year in probably 11 years, which is wild coming off a pandemic. The banks that we're working with are lending. Now, I think one big driving factor to the housing market, which I'm sure we're going to talk about, is, there was a glut of inventory. And then we had a situation where finally prices started to come down a little bit. And the next thing you know, there was just an explosion of deals. And it wasn't just, in Manhattan. We were seeing this in the suburbs as well, which I know we're going to talk about. So it was a bit of a perfect storm. But, to really dig down into what's driving this too, there has been an increase in consumer confidence. As people are getting more comfortable coming back, as the city in particular is starting to reopen little by little on a weekly basis, we're seeing more people. There's a greater level of interest, less fear. So I think we've come a long way since a year ago.
Jules and Tyron, let's talk about the state of the market as it relates to the pandemic outside of Manhattan, whether it's New Jersey. Jules, I know that you opened up an office upstate. Can we, talk about the extension of what was initially just a New York market as people moved out of the city, and what you're seeing?
Yes, that's correct. We have seen that for sure. We definitely have to separate New York City from the rest of the market and what we see in states like upstate New York or New Jersey. So the first thing that has changed is that the commute is gone for most people. And I think many of us, even on this panel or whoever is listening, I think most of us are at home right now. We're not in the office, we're working from home, we're not commuting, not taking trains or subway. I personally took the subway, I think twice in a year in New York City, which I used to take almost every day. So it has changed. The market in Manhattan it became extremely slow. We were flooded with listings, nobody was buying. And like Michael mentioned, prices started to come down, and that's when deals started happening. We actually have a small sales team of 35 agents at Oxford Property Group specializing in representing buyers. We did have the busiest month in our history in April 2021. We're closing more deals than ever. People are becoming more positive. As things are opening up, you start going to NHL games, the bars are opening now. Broadway is coming back eventually. I think people just like it, and the excitement of New York is coming back. Because when you look 6 months ago and all the restaurants are closed, you don't have a commute, you don't go to the office, why are you in the city exactly? The prices are really high, your rent is really high, your maintenance is high, and there's no fun. So that's changing. We're seeing more transactions there. But in the past, we have seen the opposite. What was happening is people were moving out of the city. So the suburbs, areas like Montclair, New Jersey, Glen Ridge, upstate New York, where you have more room, you have good education, you know, instead of your small 2-bedroom in the city, now you have a 4-bedroom house. You know, it's a different lifestyle, and people bought into it. So we saw that initially. Now people are coming back to the city. I think a lot of offices are opening in around September. So we're definitely seeing that shift, and prices are still probably going down, stabilizing, but it's not an immediate change. You know, it doesn't happen overnight. I think it will take some time to recover.
Taryn?
In New Jersey, we're experiencing a big variation because sometimes in parts of New Jersey, it's actually easier to get into the city than it is from some places in Manhattan. So we've seen such a kind of mixture. And one of the things that I kind of paid attention to is areas like Hoboken or Jersey City, where you get this huge millennial type renter population. A lot of those tenants moved out, maybe moved in with a boyfriend, girlfriend, got a roommate situation, or moved home with mom and dad, weren't going out, weren't spending their money at bars, restaurants, and they saved. They were smart and they saved. So now we have this incredibly powerful group of first-time home buyers with this COVID piggy bank that they are able to now take advantage of low interest rates, get into the market, and now become home purchasers instead of tenants. So that has switched. And then we've also got this little bit of exodus that happened from Manhattan to the suburbs of New Jersey, because you get that 4-bed, 3-bathroom home with the 50 by 100 lot and a backyard and 2-car garage. Now, when things start opening up, I think it'll be interesting to see where certain niche markets can develop, like a micro apartment, where maybe somebody's moved out of the city, but still needs a place to crash, 2 or 3 nights a week. So it'll be interesting to see the development there. But the immediate areas that are always tried and true in New Jersey, those very popular suburbs, are out of control right now. Bidding wars, 80 offers on a property. It really, really is something that is taking us back to several years ago, and we see these kind of ups and downs throughout the market. So it'll see how far it goes up this time.
Michael Cohen, I want to talk money. Because, back in 2008, 2009, people couldn't get money. People did not have the ability to get a mortgage. Developers didn't have the ability to get construction loans. And we needed that consumer confidence to move the economy. Now, I think that we are seeing, we see the construction and the activity and the buzz, as buildings are going up. We see the transactions. We see people being able to trade. Let's talk about what is the state of money, the ability for people to get funding.
Well, I think when we look back to 2008 and during the Great Recession, that was a financial crisis. This, I believe, was, it was a health crisis, and that was the big determining factor between the two. And I think you see a ton of liquidity that sits today, that plenty of money was on the sideline. So, when it looks back at it, I think when it speaks about money and construction loans and opportunities, we saw a lot of different activity that was happening in multifamily. We saw different ability to gain different rates that were available that we predominantly couldn't get before. So, there was always plenty of activity that was taking place. It was just a matter of trying to figure out, what was the right area, what was the local MSA that made sense. And I think the difference between what we saw in that recession before to now is that there was just a money amount of liquidity and cash available to developers and construction lending that predominantly wasn't there before. So I think that dates back to that being not a credit crisis. We saw the banks stand on their own. We saw the Fed act quick. They had a full toolbox full of uses that they could have, and they put to work. So hats off to the government for acting quickly. And I think that allowed us to stay afloat. And then as consumer confidence came back, that allowed many of the banks to go back. And the regulatory standards that were in place during 06, 7, and 8 were corrected. And I think now you see us that we're in much better position than we were before, and we stand in a better position. So, certainly this not a financial crisis. The banks are strong. The housing market is in place. Many of the indicators that took us down before with the subprime lending, the stated income, now, as many of the residential brokers will see, large cash down payments, all equity. So there's not this push for, speculative high leverage deals. You're seeing a lot of cash that's being deployed, which is a good thing.
Does anyone have any thoughts on the government infusion as it related to, the PPP and the EIDL loans to get people back to work? Will we see a fallout from that infusion at all?
I'll chime in on that one, Kathy. I mean, we here at our law firm did take advantage of the PPP program. It did help us through the pandemic. But, when you look at the amount of money that the government is spending, the concern is at some point in time, well, will interest rates start going up? And that's the main concern. Given the amount of government spending, I think the downside to this is eventually interest rates have to rise. So the question is, how long will this window last? Now, if I'm looking at this practically, you're probably looking at the balance of this year with interest rates in, the high 2s, low 3s on the residential side. Even if it creeped up a half a point, that's still relatively cheap money. And smart consumers, smart buyers out there, they're looking at this as an opportunity to actually buy, as opposed to wait until they actually have the funds liquid to buy a home or any type of investment. So anytime the banks are lending and interest rates are low, it's a real opportunity.
I agree with that. It's cheap money, as they say. Let's talk about the rental market, if we can. And I want to talk from both a commercial landlord standpoint and the residential landscape. Back, in the early days, landlords had to make major concessions. And are those still in place? Are we looking at high inventory, low demand, lower rents, people having, again, on the commercial office side and the residential side, having to make concessions? Let's all talk about that, because I think that's an important sector of the market.
I can talk about the residential side, especially in New York City. So everything you said is accurate. Very high inventory, rents are low. I think an article just came out by Street Easy that said that it's the lowest rent we have seen in approximately 10 years. And that's actually when Street Easy launched. So maybe it's even more than that. The situation is unique because landlords are not used to it. They were not fighting for tenants in the past. People come from out of state to New York and they're like, I need to convince the landlord to take me. I need to submit all this paperwork, my credit, my W-2, my pay stub, I need referrals. So now it's a little different. I actually know buildings where you sign a 12-month lease, you get 4 months for free. So it's incredible how far landlords need to go now to secure these tenants. So it's changing. I think it's good for people. I have seen people just seeing how low the rent is and they are moving to the city because of that. They said they always dreamed about living in New York. Now they can actually afford it. So I think it's definitely interesting. It's changing slowly. I think the biggest thing that's going to happen in the near future is school. If colleges are starting in September, I think the demand will pick up. Traditionally, summer is busy. That's when most apartments are rented, but it's not a guarantee because the market is flooded with apartments, constant price drops. The tenants are in a very good situation. They have a strong position. They can negotiate, ask for more free month. Broker fees are almost gone. It's really hard to charge a broker fee. They are mostly paid by the landlords these days. We recommend it to every landlord we work with. Please pay our fee instead of charging the tenant, because otherwise we'll get no traffic. So it's definitely interesting, but it's not the same for the boroughs like Brooklyn and Queens, where the demand is much higher. Landlords are in a stronger position. The lack of commute kind of shifted people to look in areas that are further from their offices.
I think you should too, on the landlord side, especially in multifamily, predominantly in Manhattan. The margins were this thin that they were operating on to begin with. So it took one hiccup, it took one setback that they would have an issue. And then obviously forbearance, the ability to have, rent that you didn't need to pay and people needing to get PPP. So it was this tight to begin with. And then what happened just inflated it. But you look back, they had an 11-year bull run when basically interest rates were next to zero. They were having plenty of equity. They were refining and getting their cash out, and there was tons of supply being delivered that was being absorbed. Now, there still is only one Fifth Avenue. There is only Broadway, and there's still the hub of it being there. But it will be interesting to see on the comeback, what it looks like. Will the offices dictate it? Will bosses say, I need you here 5 days a week, and the remote is no longer an option? Suddenly, does that, 3-bedroom, 4-bedroom house that I bought that takes me an hour to get in, does the city start looking a little bit more advantageous? Did I pull the trigger a little too early by moving out in my young 30s when I was going to wait till I was 40? So all that, I think, is going to be a mystery until we finally see this get post pandemic and realize really where we are.
I absolutely agree with you. I think that's definitely something that we're going to see in the future. Panning out and playing out is people pulled the trigger. I don't have to go into my office. I'm never going to have to go back. This remote working situation is awesome. And they buy the big house in the burbs, and then the boss says, okay, now you got to come back, playtime's over. Let's come back into the office. And I really think that there's going to be a shift in another type of housing, and really a pied-a-terre or secondary home is going to be kind of necessary. So a micro apartment that you go to the city, you work your 2 days a week in office and then leave. I think that's going to be something that we're probably going to see in the next few years, because I think overall the long-term effects of the pandemic are that it has changed how we work and how we interact and how we do business. I think this whole Zoom meeting situation, is going to be here for a while, and people don't necessarily have to be in a brick and mortar office. So there's going to be a lot of changes. But again, the rental market in terms of residential in New Jersey has also softened very much and shifted very much, because a lot of people just were not needed to be so close to the city.
I think, Kathy, the key word there is concessions. And I think we're seeing concessions, the glut of inventory on the rental side, especially on the residential side. We've had high inventory, and we have clients who are looking to increase the size of their apartment, who are selling the smaller apartments and then realizing the better deal might be to rent the apartment to get that third bedroom. But I think the biggest question, and Taryn hit it on the head, is what will employers do? When will employers bring the workforce back? And has this remote work concept changed the game? I, for one, moved to Bergen County, had a place built, and I built out a home office. I am working out of that office twice a week now. And many other people are doing the same thing. So the question is, I work for myself, so, I can set my own rules, but I have to think about, well, how am I going to treat my employees? But on the bigger picture, if you're following the news, you're seeing a lot of these large corporations announce decisions about when to bring back the workforce. And the interesting thing is the reaction. So I think in many cases, they're testing the waters to see what the reaction would be. And typically speaking, people are getting very used to working at home. And from my standpoint, people are just as efficient. So if employees are just as efficient on the home front as they are in the office, as much as I like to come into the office, and I've been coming in to this city since July, but you know what? I'm the exception, not the norm. And maybe I have to change.
Michael, I am in 100% agreement, and I want to use that as a springboard to kind of shift the conversation to how all of you pivoted and basically set your businesses apart as a result of the pandemic. I believe that we have shifted as a society. I think that this is going to be part of how we do business, how we attend an expo, how we attend a conference, how we communicate, how we close transactions remotely. I'm doing, estate planning, and we're going to be closing and signing documents with witnesses remote in my attorney's office. They sent us the paperwork, my husband and myself, and we're going to be signing it with the witnesses remotely. And Mike, I know that you're doing, a lot of transactions remotely. So I believe that we figured it out. We figured out how to have kids, in school remotely. We figured out how to work with our workforce remotely. And so I want to talk to all of you about how you shifted your businesses, how you have kind of readapted in the last year.
Well, I guess I'll kick us off. When we're looking at how we changed. Now, the world changed overnight, and we needed to act. We had all of these deals, whether it would be banks who are lending on the residential or commercial side, or folks buying or selling. How are we going to get these deals done? So we had this pause. When we were in the height of the pandemic. I will tell you, a very small percentage of deals died. Most deals eventually stalled, but eventually closed. But they closed in a different way. In the commercial side, this concept of mail away closings was more common. I'll send documents to a client, they'll sign it, they'll ship it back. But in residential, we were so old school. We had to have these in-person closings. And that has changed. The question is, will it change for good? But that has really changed. But what we had to do, and all companies had to do this. So we have about 50 people, but we had to get everybody set up, and most were with remote access. We had to figure out a way, okay, how do we move money? How do we get documents signed? We had to up our game with real estate technology. Now, we were ahead of the curve to begin with, but a lot of work had to be done. But I will tell you something, even with all of that, we were still under the false impression that we needed to be back in the office to do it right, that we couldn't truly oversee our staff. But you know what? The numbers proved us wrong, which was amazing to me. Now, I'm old school, right? Mask up, go to the office. But you know what? Maybe I'm a dinosaur. And at the end of the day, it had to change. And we opened up our minds and realized everybody's just as efficient as long as we provide our people with the tools and technology they need. And they're just as efficient. Works for me.
Well, what does that mean in some ways for New York, right? Because New York isn't just people living here. It's people going to school. It's Broadway. It's the financial markets. It's the offices that are open in Bryant Park that's full of people in the summer, or who are working in Midtown. I mean, what does it mean for all of that? I mean, if any of you have been in New York, in Midtown in the last, week and a half, 2 weeks, I mean, it's not what it was.
Now, I want to chime in real fast, and then sorry, Michael, but my partner and I eat lunch in Bryant Park, at least once a week. And in July, it was he and I and 3 or 4 homeless people. And now we're seeing every week more and more people. But you know what? To us, that's just a sign that we're getting better and better. Go ahead, Michael.
So I'm on the Upper West Side. So get myself into Midtown or get around there and see it. But it's not just, the area of which has changed there and just the personnel that you may see that it's not as busy. To me, it's the trickle down of how that affects all the properties around it and all the different, the businesses. Gone are the, the power lunches of, seafood towers and steaks and drinking and all that, where you'd have that out for 3 or 4 hours and people were spending money. People that are staying in, the flag hotels in Midtown that are coming up, people that are doing the conferences at the Javits Center that have, bars and restaurants rented out. So to me, it's like it will come back, but also it's monitoring how long and that, that to see the rise again of those ancillary businesses that are, the casual spots for lunch, you got to get your $23 salad somewhere, but it's how does that come back and when does that come back? And to our side on how we dealt with COVID, we predominantly run a private equity that's debt focused. So for us, it's all about, our income is generated through interest and that's kind of how we generate it. So we went back and we worked with our sponsors and borrowers if they were proactive, and we went through a forbearance on a few, but we had very good collection rates. And I think that was a testament to our ability to adapt quickly, to get to our borrowers and sponsors quickly, and to have any of the questions they needed answers. And that's what we did. And during the shutdown, obviously construction halted for some time, but we were able to bounce back. And the good news is we're delivering product in areas that still have a lot of upward mobility and room to grow. So that's one thing that we were kind of pleased about seeing.
Jules, how did your brokerage adapt? And do you believe in that the traditional brokerage model pre-pandemic is still viable?
Yes. So the first thing I just wanted to point out quickly is that I think there are some challenges that we're not prepared for yet. For example, Oxford Property Group is pretty well established. We have employees that's been with us for many years. We know each other. We hang out. We went to bars, had dinners and all that. But what if we hire someone new? how effective can they be without any kind of physical interaction? And I think it's a question for Michael too. If you hire someone new, can they be part of the team without actually meeting up just through Zoom all the time? So I think that's that's a challenge that we have to face down the road. In our experience, it can be successful, but it does take an effort, and you have to really pay attention and establish that relationship. Us, for example, we actually opened an office in Kosovo, in Eastern Europe, in Pristina, in January. We have 10 employees there. They are helping us with all kinds of tasks. We never imagined all the things that they can actually get done. We are extremely happy and impressed with them. Initially, I remember I wasn't sure what we could get done in Eastern Europe. It's a different time zone. They are 6 hours ahead, and and we have never been there. We opened the office, we're paying rent, and sometimes I have a call with them like this, and I'm like, can you show me the office? I know we pay rent. I just
the office you're paying for, right?
I want to make sure we do have an office, and there's 10 of them, and they are incredible. Like, we're very happy with it. We never met most of them. They have never been to the US. We have never been in Kosovo, never seen the office we opened, and it's working. So to me, that reassures me that this remote work can work, actually, if we put in the effort. We just have to set up better technology. We have to set up a better conference room, better video, better sound, and really have these video calls where we can connect and chat and get to know each other. And we also look forward to traveling, but that's not going to happen every week or every month. So that's one thing that has changed for us, for sure, outsourcing.
And Taryn, how have you seen the brokerage business kind of?
We actually did in-person tours of properties through the entire pandemic. We didn't skip a beat. We never stopped. We did take quite a few safety precautions and really made sure that the buyers were safe, residents were safe, everyone involved was safe. But what we did was look at it as, how can we vet buyers and have people decide if this is a home for them, and all they need to do is come and just check it out. Like Jules was saying, like, I'm paying for an office that I've never seen. Buyers coming in, doing essentially an entire tour virtually, and then just coming to make sure, okay, this is the apartment that I saw on the video. So yeah, I'm okay, I want to buy it. And it was so important for us to include that human element, because I feel like everyone's kind of been starved for through this is human interaction, is that communication, are these kinds of talks that are in person, because we haven't really been involved in any sort of relationship, but with a computer screen that's in front of us. So by inviting people in, making sure that we were taking the appropriate precautions, when buyers did come in, they pulled the trigger. And that's why we were able to stay so consistent with our sales and leasing through the entire time, because people were like, oh, wow, you're open to welcoming me. You're adding that human element in. I feel comfortable. I feel good. Where do I sign? So we made sure to try and keep a little sense of normalcy and give people some comfort in that respect. If somebody only wanted to be virtual, not a problem, no worries. But we gave buyers the tools to make decisions on purchasing or coming in person to visit throughout the entire time through the pandemic. And now it's just gotten so easy, and we've got a great system down, and things are just a well-oiled machine. So my team knows exactly what they're doing, and it's really great. And buyers are just chomping at the bit to sign contracts.
Michael Romer, let's have you chime in. Per the Real Deal, your firm did more transactions over $1 million than anybody else. That sounds like a well-oiled machine to me. How have you been able to adapt to closing all these transactions?
It was an uphill battle, and we're only as good as the people behind us, right? But it really it was a coordinated effort with law firms, banks, title companies to all get on the same page and to figure out, okay, how do we move money efficiently? How do we get documents signed efficiently? How do we get these closings completed? Because we had to do whatever it took. I mean, there were situations where people were being sent to the porches on somebody's, home front property, and documents are being signed, or documents were being signed and drive-bys, whatever it took. But technology, right? Getting documents signed electronically. I'm a big proponent of contracts being signed electronically. However, as I'm sure Michael will agree, when we're talking about bank documentation, there are some documents that we want to have those wet signatures. We want to have, a bank wants to see original signed documents. So there's a way to do that too, but it really took patience, right? You can close a deal where everything basically closes in escrow, and then let's say the deal funds the next day, where money gets moved the next day. Now, other parts of the country have been doing it this way a long time. And we needed to just change, but it really was a coordinated effort, because there were a ton of transactions. And thank you for mentioning the Real Deal rankings. I mean, it was really exciting, for our firm to be put in that category. And then when you're looking at the size of the deals, we, I think, ranked 10th in overall sales volume in terms of the amount of deals that were actually sold. And then we were compared to these bigger firms doing these $100 million transactions. But it just goes to show you, if you do it right and you do things the right way, and you really, cross your T's and dot your I's, and you do it professionally, you can get it done remotely. So think about it, a record year with no in-person closings. I mean, it shows it can be done.
And I have a Be Nice to Intern story. Amir Karangi, who's the founder of The Real Deal, was my intern 30 years ago when he was in college. I gave him his first journalism job. So, look at how that turned out. Let's talk about the future, because we're not quite there yet. We're not quite at, people coming back to the offices and all that. What will we be seeing as we move into the summer? Will people be incubating and waiting at the gate to come back in the fall? What do you think is going to happen?
I have to be home because my team is is chomping at the bit in the office, and my office is so busy. So that's why I'm home, to get some work done in quiet. But, I think there's a lot of people are excited to go out. We just hosted an event at one park and had an amazing turnout. And we did an art gallery opening that we were able to be socially distanced. People want social interaction, is what I have learned through this. People want to interact. It's nerve-wracking, but people crave interpersonal connections. So I think that people are going to be excited to go back, but like we were talking about earlier, some people pulled the trigger and moved a little too far away. So it'll be interesting to see how that kind of affects the market too.
Are people going to continue to move into the suburbs and move out of New York? Michael Cohen, Michael Romer, what are your thoughts on that?
As a 33-year-old and just recently married and living in a shoebox size apartment, I could say that it's certainly, as we discussed, an options. And then you look at a low rate environment, but it's just, I don't believe it to be a house of cards. I don't believe it to be 06, 7, and 8 when we saw subprimes and all that moving. The housing market is strong, and I think the reasoning behind it is because there is just substantial amount of equity that is being put up, where you got to have a little bit better feeling that this is not the same look we saw last time. Now, certainly there's things you need to watch and monitor. And, when there's 42 multiple offers on a property that's trading at 3 times what it was, that's got to be a little bit of a head scratcher. But, there's reasoning behind it. And, there's people that, are wanting that lifestyle, and maybe we're forced into it sooner than they were imagined. But yes, I do believe that there's probably still room to grow in that outside, tertiary markets. But make no mistake, I mean, the capital markets that are ahead still is in Manhattan. The action is probably still there, but we're just talking about the Northeast. But if you look at the likes of Florida, Texas, all those states, people began to realize, obviously, a tax advantageous route may have been going there. And for the amount of taxes they are saving and the cost of living, they can jump on any flight and be in Midtown and complete their meeting and head home. So I think it was an eye opener. I think that, this is maybe the wake up call. And the good thing about New York City is it's going to become affordable and cool. People are getting priced out at $3,500 a foot, and it's hard to say that anything is worth that per foot. And now suddenly there's a whole new buyer's pool that's coming in, and it's exciting to see that maybe it's getting back to being where this is like hip and cool and fun again, versus it just being like very hard to even compete with anybody because it's just such a high wealth gap at the top.
Kathy, the Wall Street Journal had a crazy statistic that might blow your mind. And it was that the housing market is about 4 million nationally, is about 4 million homes short of current buyer demand. So short of current buyer demand. So that means the demand across the country is huge. People are seeing the opportunity. They're seeing, all right, prices might be coming down depending on the market, and then interest rates are low. It's an opportunity. It's, I believe, a short-term opportunity to buy because it will correct itself eventually, right? But when you're looking at people leaving New York, look, Michael hit it on the head. Taxes did drive a number of people to look elsewhere. Remote work did drive companies to look elsewhere, and maybe employers and employees. So that's the big question ultimately, right? Can you conduct business being in a remote, maybe in Florida or in Texas, and still be relevant in New York? That's up for debate. Do you need that office? I have 11,000 square feet here in Midtown Manhattan. Do I need all of that right now? No. Will I need it in 6 months? Maybe. So when we're negotiating with landlords, that's a big question. But in terms of people leaving the city, like the way I'm looking at it right now, people are leaving, but more people are coming in. And so that's what we're seeing. But in New Jersey, now I'm a New Jersey transplant. I was a New York City born and raised. I moved to Bergen County. I said, this is great. And I'll tell you, in the town that I live in, I think houses are lasting on the market 2 to 3 days. And this is what we're seeing. People are saying, well, okay, what did I miss during the pandemic, right? What did I feel that I didn't have, which drove me, maybe I wanted to have a pool or some extra space. I could have that, improve my quality of life, see my kids more, my wife's less mad at me, and still be efficient on the work front. If you can pull it off, it's a perfect storm. The question is, will it last? When companies come back, will they expect their people to come back? Now, in many cases that will, but to Michael's point before, that drives everything, drives the restaurants, it drives the retail business. One really feeds off the other. So I'm really curious to see how it plays out, but all positivity right now.
I agree with you that as a business owner, we can transact, we can function. I had a really prominent attorney tell me, but I can't really fuel my business through networking. He said, I got most of my business through networking, through going to the cocktail parties, the lunches, and those types of things. That's where he expanded his network. So hopefully we will see that, and you really can't do that remotely. I want to ask kind of a wild card question real quick, if I can. The Biden administration, if they, if we see an increase in capital gains taxes, estate taxes, will that impact transactions?
In short, yes. I mean, there's no way around it. Anytime you're looking at, when you're looking at the capital gains tax, right? You're looking at taxing individuals' income that's already been taxed. So it's a disincentive for them to invest in real estate. So I think that's something to keep an eye on. We have the 1031 transaction as a vehicle to defer capital gains, which I'm sure Michael uses a lot too. But when you're looking at these tax increases, you probably saw me get uncomfortable in my chair because it does make me uncomfortable. When you have a recovering economy and it starts to get taxed heavily or regulated heavily, it can have a negative impact. And I noticed somebody in the chat too also brought up, universal rent income, and these regulations that are out there. So when you look at the potential of increased taxes and, additional regulations, when you're looking at the private housing market or the commercial real estate market, it could have a negative impact. So we have to keep an eye on that.
And wealth for multi-generation has been compounded through real estate. So, these 1031s, you keep rolling and rolling, someone's left holding the bag sooner or later when it comes, the tax man comes looking. So I think, yes, in the short term, absolutely. And we will see how it pans out. It's, the reinvestment idea of it and all these new programs of opportunity zones that came out and things like that. The idea was, real estate's the trigger. It starts with it and everything trickles down from there. So when you take that back, people are going to either figure out other ways around it or, they're going to just be less advantageous route to go through real estate, which is really it was, a hedge against inflation. It was a good tax shelter. It was all those things that they, wealth wanted to see because they knew that was a way to compound it over years and years. So it's going to be interesting to see how it rolls out. And to Michael's point, a recovering economy, and then dropping that in is, the markets are reacting, but we'll see what happens in the long term.
When Michael was talking about, people going to Florida and things like that, those are some of the triggers. I mean, people want to preserve, their equity and their savings, and real estate is such an investment builder and wealth builder, as you said. Let's talk a little bit about tech. We're going to be going to questions in a bit, but technology is, to me, the future of stabilization as it relates to being able to transact for any business. Jules, Taryn, Michael Cohen, Michael Romer, how do you see technology playing a role in really the continued growth and stability?
Jules, you want to take that one?
Sure. So for us as an agency, I think the technology that it's helping us with is just giving the tools to the agents so they can perform their job from home. They can do everything through our dashboard, our website. It's definitely changing. The consumer has changed, the demands have changed, the expectations. We just need to prepare for that. First of all, we have a lot more forms to sign because of COVID. We're doing all these digitally. The consumer is a little more hesitant to go out and see something without us providing a Matterport, a 3D walkthrough of the apartment. They want to confirm that it's a perfect match. We have a video. Now we include pictures of hallways, pictures of the building. We share a lot more information up front to make sure that they go out, and the closing ratio became much higher because of that. Because if it's not a perfect match, they're not going to go out and see it. They can already decide at home with a 90% confidence that, yes, this is going to work for us. And I remember the shock, and Michael spoke about this briefly, when 2020 April, we had all these contracts signed and the closings, like, now what? What do we do? What do we do with these? How do we do an inspection? How do we do a closing? Do we attend? How do we get paid? Instead of getting a check now, it's wires. Instead of showing up for a meeting, it's just done through Zoom. It's phone calls, it's digital signatures. It's changing. It's changing quickly. I think it's amazing, actually. I'm very happy because real estate, especially in New York, was stuck in the, I don't want to say 90s, but at least way behind of what the technology was capable of. We never took advantage of it. And now finally, we got the push that we needed to actually transact like it's 2021. I think it does feel more like 2021 when it comes to these transactions. So we're not stuck in the past. So I'm hopeful for this. I think the agents are better off, the consumer is better off, the transaction is a little more seamless. And I think we're still just seeing the beginning of it. I think there's a lot more to come, a lot more startups providing amazing services. So I'm excited.
Kathy, you mentioned before you had somebody who said they really couldn't network because they were missing that in-person connection. We actually had the opposite experience. When we launched this online real estate education platform, the New York Real Estate Center, the idea was, well, let's put ourselves out there and try and connect with as many people in the real estate community as possible, provide continuing education, provide webcasts, really just provide content. But it was a forum to really keep people connected. And I will tell you something, over the course of 6 months throughout the pandemic, when we were mostly at home, I think we gave out about 10,000 certificates to real estate agents in the New York area. Our referral base from that at the law firm has doubled. The amount of real estate agents and brokers and bankers that we've touched, because we were able to utilize technology, it's been a blessing. And like I said, our referral base has doubled. We're seeing that in the volume of deals that we're working on now, but it's really enabled us to touch more people without having to go to maybe Jules's office and do a presentation in front of his staff of 50. Now we could actually do something like this and touch countless people. And it's really paying dividends. I think it's here to stay. I think ultimately you will see a hybrid, a mix of those lunches Michael talked about with virtual presentations. And in New York State, we actually approached them early last year or soon after the pandemic, and they granted us the ability to provide continuing education virtually. And that really just opened up the floodgates. Now, a lot of other folks are doing it now, but it's just a great way to keep people connected until it's safe to put 100 people, in an auditorium again.
Michael, I agree with you. I mean, I think that this is in person to me. I'm seeing you. I'm in the room with you right now and with all of you.
Likewise, Kathy.
So
I've never met Kathy in person. but I feel like Kathy and I know each other. We've done what, 3 or 4 of these conferences together now, Kathy, and I feel like if I saw you, I'd be like, oh, hey, it's like we're old friends.
Exactly. So this is the way to network, Michael. And I've attended chamber events and cocktail parties. And I almost feel like I'm even more booked. Sometimes I end one and I realize that you actually can't be in more than one Zoom at the same time because I try.
You know what? It's a lot more efficient. And if you're really looking at that as a business owner, how can you touch more people and use your time efficiently? An hour Zoom presentation, or some other technology is the way to go. And I tell you now, it used to be you would go and do a presentation to 20 people at this office and then that one. I like it a lot better, but you do need to supplement it with eventually the in-person lunches and the in-person cocktail parties and things like that at some point in time. But for now, we're enjoying it.
Just the adage of working smarter, not harder, is really coming to light. And which, as long as we don't get rid of the closing dinner, I'm fine. Let's just
as long as you're buying, Michael.
Well, hey, as the lender, we have rules nowadays. So the attorneys got the deep pockets.
This is true.
Hi, Anthony.
How are you? I think you guys are all wrong. We got to get back to the live NYC Real Estate Expo.
Definitely need one of those for sure.
No, Michael, you are so right. People are just going to stay with the virtual until it's safe. And it is working. It's definitely working. It's working out nicely. But guys, what a great panel. Love to hear more. We are getting some questions here. So let's jump right into the questions. Okay. We got a first one from Edward. Can any of you comment on the universal rent control bill in the New York legislation now mandating rent control for all units? Will it destroy the value of the multifamily in New York City for buyers and sellers? And anybody can answer that.
Well, I'll start us off. I did touch upon it earlier, this whole concept. Sure. There is pending legislation to regulate the, unregulated side of the rental market. And when you do that, we're dealing with a territory that could be a little troublesome. If you're starting to dictate to private landlords, how much they can increase rent, I'm of the opinion, look, as long as it's not rent controlled or rent stabilized, that's regulated. That's governed by the state. When you're looking at unregulated apartments, a landlord, a property owner needs to, they need a return on their investment. And if they're limited in terms of how much they can charge and rent increases, it really takes away the incentive to build rental apartments in the first place. So I think it's something we have to keep a very close eye on. Universal rent control, in my opinion, is dangerous.
And like I said, when they're operating on those type of margins, it takes just one little hiccup there from Albany to come in that says that they need to do this. And, that's kind of where there was a point probably I wouldn't even want to take a multifamily, just because of the uncertainty and, the certain overlays of like the Soho district that's going to, there's just things that come across, and obviously they take time to go through, but it's certainly a very eye-opening, that you need to be mindful of it as you move forward, especially if you're going to operate and own multi in the city.
Anthony, my feeling is build more affordable housing, regulate the existing rental market less. So create more, because there is a need for more affordable housing, especially in the NYC metro area, even into New Jersey. There's a need for more affordable housing. The funny thing is always to me, when they call it affordable, does that mean it's really affordable? We need true affordable housing for people that are looking for a home or that are looking to live in the New York City area and surrounding areas. But again, nobody ever feels bad for the landlords, but we need to make sure that they actually are turning a profit to encourage them to buy more buildings, to build more buildings, because we're looking at a situation where people do need homes, but we have to be very careful. And right now there is a glut of inventory on the rental side. And if you're going to start regulating that more, it's going to put the landlords in a tough predicament.
Guys, I know this is not a question, but what do you think about the little brothers and sisters of the boroughs? How are they doing helping out Manhattan? Are you seeing, Taryn, why don't you start off with New Jersey? Being New Jersey, Brooklyn, Queens, Bronx, are you seeing them getting a tremendous amount of new business? people moving there and also open up their offices there? Are you
New
seeing a lot of
Jersey
that?
is, yeah, New Jersey is just always, I know there's always this stigma like, oh, New Jersey,
Yeah,
but
but has that
I'm
changed?
sure Michael can attest, New Jersey's not that bad, okay?
Yeah,
We're,
yes.
I took
we're
the
doing
plunge.
just fine. We have great bagels and pizza. Uh, so, New Jersey, a lot of businesses have moved to New Jersey and offices have opened up in New Jersey. And, there's always, Manhattan is always going to be Manhattan. It's one of those iconic places. And unless New Jersey breaks off and goes and floats away in the Atlantic, we're always going to be very close and that really easy kind of best of both worlds situation. So, there's been shifts, there's been changes. New Jersey has a huge pharma industry too. We've got lots of medical, which through this pandemic has been huge. So New Jersey's great, and it's a feeder market for New York. It's always back and forth. And I really think that while there might have been a little bit of a slowdown or maybe a hiccup, even look back to 9/11 when everyone thought, oh my gosh, everyone's going to leave New York and never come back. What happened after that? Here we are, a decade later, decades later. I still think we're back in the 2000s, but New York's great. New York is tough,
Now,
and so is Jersey, and we're
Yeah.
not going anywhere.
Tyron, you represent the DMG multifamily unit.
Yes.
And is that fully occupied?
We have gone from a very slow occupancy to boop. So we're almost there. We're getting there. It's
Yeah.
amazing. We're starting to see even in new construction, buyers are wanting to outbid each other on new construction, which we play nice in the sandbox. When someone comes in and reserves a home, we don't steal it out from under them. So we just shift someone to a different line or residence. We don't like to do that. So if anyone's looking to not get into a bidding war, come on over to One Park.
Very good. Very good. Okay, we have, let's see here. Which prospective candidate, if any, will be the best for the real estate industry? I guess that's the mayor you're talking about.
That's a good
I'm not
question.
sure. What's that?
Yeah, that's a great question.
Yeah, I'm not too up on all the candidates, but is there one that's really friendly with real estate?
Michael Romer.
Michael, do you know Michael Romer?
That's one for you.
There's a great line in Hamilton, talk less, smile more. Don't let them know what you're against or what you're for. So
True. So
in all seriousness, though, there are a number of strong candidates, and
that's good.
I think you have a few options that would be friendly to the real estate industry. So I think as their positions roll out, we could get more clarity in terms of who would be best for the real estate community, because we do need a mayor that does see the value of New York City real estate, that will work in hand with REBNY and the brokerage community to come up with policies that actually improve New York City real estate and improve the value of the real estate and understand the impact of additional taxes on real estate valuation.
Very good. Thank you, Michael. Michael Allen, fabulous panel. Thank you, Michael. Michael Allen again, when do you think open houses for the sales market?
Right now, obviously in the height of the pandemic, there were serious restrictions on open houses. They have eased in both New York and New Jersey over time, as I'm sure Taryn can touch upon. But look, I think the brokerage community is being smart. It's being smart, it's being safe. Nobody's going into open houses, without masks on and without the appropriate safety protocols. And I know, Jules, this pretty well in New York.
Yeah, so the first thing is obviously the rules have changed for buildings. You cannot just wait in a lobby anymore. You can't have 12 people, you can't have a line. So what happened is we started scheduling them by appointment, usually 10, 15, 20 minutes apart. You must have an appointment. So you will see open houses by appointment. So I would recommend everyone not to just show up and confirm that you have a time slot. many buildings have rules in terms of how many people can be in an elevator, how many agents can be present at the same time. You know, it became a little trickier to schedule these showings in terms of, let's say you have two buyers, you as an agent, maybe your partner, you go from one place to another, you take a cab. How do you do that? How do so many people go together? You know, if you can only have 3 people in an elevator, somebody needs to wait downstairs, you go up, you come down. So it has changed. So I think the solution is, for now, is just open house by appointment. That's what we're seeing. Is it going to change soon? I actually don't think it will. I think we're going to stick to these open houses by appointment more, providing a more personalized service, I would say.
Thank you, Jules. Leon Ye wanted all your information. Leon, I will send that out to everybody. Someone was asking for Billy. Well, Michael's here. We'll get you. We'll make sure that Michael tells Billy that you're looking for her. Rachel Bona. Ron Lorenzo. Yes, this was a great panel discussion. Lots of good information shared. Thank you all. And guys, I want to thank you. We came to an end. This was fantastic. DMG is by all means putting together some great panels. They have 4 more with us. So next month, we will definitely, as soon as they put that webinar together, we'll be out there promoting it as soon as possible. But once again, everybody, thank you so much. And we will send out a thank you letter. We will send out the contact information of this panel to everyone. And we will have the video within a couple days or so. We just need to edit it and we'll send it out to everybody. But once again, thank you, everybody. And thank you, Kathy Hobbs, for moderating this panel.
My
And
pleasure.
thank you, DMG, for putting it together.
Anthony.
Thank you, everyone.
Thank you, Kathy.
Thanks, everyone.
Thank you, Michael and Jules. Have a great day.
Have a good
Take
one.
care.
Bye, guys.
Take care, everybody. Bye-bye, everybody.